I really do believe that the only people that are pulling it off in a meaningful way have that full vertical integration,
Yeah.
which takes time to build up. So I don't think this is a forever thing, but I do.
Hustlers podcast. I'm your host, Josh Appleman, founder and CEO of Appleman Capital. Today we're joined with Clint Harris. Clint is a real estate investor and former medical sales expert. He has successfully developed over $100 million in commercial assets, specializing in transforming properties. He advocates for financial and location independence. Clint, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Hey, Josh, appreciate you having me on. Thank you very much. So, yeah, my name's Clint Harris. I'm in Wilmington, North Carolina. I had a 16-year career in medical sales, implanting pacemakers and defibrillators. It's kind of a young man's game, beats you up a little bit. You're taking call, working weekends. So I always was driven to kind of look for an off-ramp for that lifestyle and figure out just a way to get my time back. And so through fast forwarding through a career of a lot of bad real estate investing, went through single family homes. We had 9 single families, did some burr properties, did some flips. With limited success in 2017, I took a promotion, moved to Wilmington, North Carolina, to the beach, which is the area that had opportunity to start dabbling into short-term rentals and Airbnbs. So bought a house hack duplex 2 blocks off the beach, had a lot of success with that. Understood the value of multifamily in that space is a much more powerful way to move forward than with single families. So started buying multifamily. We ended up with 3 quadplexes and a duplex that we had long-term month-to-month tenants in them. When we got them, moved the tenants out one by one, renovated and converted the properties to a different asset class from underperforming long-term tenants to top-performing Airbnb properties. In the effort of trying to make that more passive, we tried to find a property management company to manage that. We were unsuccessful in finding anybody that could hit the numbers we were looking for. So we ended up building a property management company from the ground up with some partners that manages our listings plus another 85, which was great, very labor intensive, took a couple years. And at the end of that time frame, we had been fairly successful in replacing my income in terms of medical sales. But we started off chasing that financial freedom, but what we didn't get through that highly active investment strategy was time or location independence, right? So everybody's chasing financial independence, but if you get there with a portfolio that requires you to spend a lot of time in one location managing it, what you don't get is that financial, and you get financial, but you don't get the time and location independence. And you really have to have those 3 things together to have any kind of independence of purpose and decide where you want to go, when you want to do it. So that highly active investment strategy is what really pushed me to look for, okay, what's the most passive investment strategy that I can find that is highly scalable, that's going to affect our lives in a meaningful way? And that's what led us to self-storage and then conversion projects and syndication.
Yeah. Yeah, you're hitting it on the head. It's location independence, being able to go out and do what you want when you want to do it, and you're not leaving the entire business behind you, hoping that things don't break. And that's, I think, the purpose of real estate. But we tend to get into the weeds. We're used to getting into the weeds, the operational side, and then that kind of just keeps pulling you in and dragging you down. It's ultimately because we care about the baby, and we can't let the baby go into someone else's hands, which I agree with you. In property management, it is extremely tough to find somebody that can effectively manage a property as good as you can effectively manage it third party. Ultimately, they've got bills that they need to cover and expenses, and number one in their mind is them, property second. So it's can you tell us a little bit about how you guys overcame those challenges, and then how you gained traction on your property management side?
Yeah, so you're exactly right. Nobody's going to manage your business the way that you manage your business, right? So within the short-term rental space, we spent a lot of time building out a system to try to automate that as much as possible. Luckily, now there's management software and messaging that you can put in place. And so really it was after we built that out, we spent a year or 2 saying no to other people asking us to manage their properties. And then finally we just caved and we're like, look, this is the next natural step. And so we took the system that we'd already built out in terms of automation and the messaging and communication with cleanings and the linens and things like that, that it just made sense to roll it out. Now, what I will tell you is that it didn't scale linearly the way we expected it to, in terms of the amount of time and energy that we spent on a portfolio of 14 properties. As it goes up, you'd think there's economies of scale, but the reality is it doesn't scale that way. As you grow, you create new lines of responsibility. You know, you've got cleaning teams, and then you've got cleaning managers, and you have oversight, and you have
Yeah.
inspection, and you're, as it goes up, your fixed overhead doesn't go down.
Yeah.
It goes up, because that's a strategy where, you know, you have an apartment building that has 60 tenants and 60 different units. That's one thing, versus if you have an Airbnb property, you have 6, 8, 10 tenants per month in one unit. They're paying a lot of money to have a high expectation. So is the juice worth the squeeze? Sure, of course it is. But in terms of keeping the quality where you want it, what's your ability to scale in a way that affects your life in a meaningful manner? In terms of, if you know what your net is per door, how many doors can you scale to before the quality starts to go down and your name is on it, right?
Yeah.
So for us, the boutique style in terms of our own properties, the boutique style in terms of property management and having individual managers that only handle a few properties, that was the way to get there. The important lesson for me was moving forward and looking down the pipeline as to what's our cap, like what's the ceiling as to what we can accomplish with this. And I did the same thing with my medical sales career. It's like, it's a pretty high ceiling in that job. If you're going into heart surgery and you're putting in pacemakers, it's a high ceiling. But if you can find out what the ceiling is, it's calculable, right? So if you calculate what that ceiling is with your occupation, you calculate what the ceiling is with your current investment strategy in real estate, your ability to scale, the question you have for yourself is that ceiling high enough for myself, my spouse, my children, and the amount of time I want to spend with my family, the travel I want to do? Is that ceiling high enough? And if it is, then great, you hit the jackpot. If you decide that ceiling's not enough for you, then the only real risk you have is not doing something different and not trying something else. And so for us, there was a shift there where I found out what that maximum level of scale was in terms of the profitability per hour that I have and per dollar that I have to invest in real estate, and the amount of time that it takes. It it told me that it was time to make a shift. And so I started looking around at the most successful real estate guys that I knew that had been doing it for a long time, the older guys that look like they're sitting around not doing much and they have plenty of money. What are those old guys doing? And ultimately it was usually one of three things. It was money lending and hard money lending to house flippers, private money, or it was mobile home parks, or it was self-storage. I had no interest in mobile home parks. I didn't have enough capital in a meaningful way to lend to anybody, and that led me to self-storage. And through networking, through our local real estate investor meetups, I met the partners that I have, father and son team of Eric and Levi Hemingway, who are general contractors who've been building their own self-storage since 2006. We went and bought an old Kmart building in Reidsville, North Carolina. We converted it to a Class A climate controlled self-storage facility. If you think about big box retail, that space is pretty much dead. Amazon has wiped out that space. There's very little appetite for those buildings. They're pretty much worth what someone's willing to pay for them. So we can go typically buy a building for a couple $1,000,000, put a couple million into it, convert it to Class A climate controlled self-storage, fill it up, and it's going to be worth $9 to $15 million, depending on the size of the facility and the average rates for the market. So we did one of those properties as a joint venture in 2020. Last year, excuse me, 2022, we did 6 more. We did 2 Kmarts, 3 warehouses, and a grocery store. That allowed me to walk away from my medical sales career in November of 2022 and focus full time as a general partner with Nomad Capital. We raise capital from investors. We buy big box retail across the Southeast, like Kmart's, grocery stores, warehouses, convert it to Class A climate controlled self storage, and continue to scale. We hit our 2-year goal of 100 million in assets under management. We've got a 5-year goal of 500 million and a 10-year goal of $1 billion. And the really cool thing for me is that the lesson of what we're doing is exactly the same thing that I was doing with duplexes and quadplexes that were Airbnb properties at the beach. It's just an asset class conversion. We were buying nasty quadplexes with long-term tenants in them that were chain smoking, an undesirable property, hadn't had a rent increase in 10, 12 years. We move the month-to-month tenants out. We renovate. We convert it to a different asset class, to a short-term rental. When you convert it to a different asset class, you change the formula by which the asset is valued, and it drastically increases the value through forced appreciation. The
Yeah.
beauty of that is, like these Kmart facilities or big box retail, on the day that we're opening up the doors, we have certificate of occupancy and we cut the ribbon and we're renting out units. We're usually sitting around 30 to 35% loan to value. We bought it for a couple million, we put a couple million into it, and it'll be worth anywhere from 10 to 17 million dollars depending on the size of the facility and where it is, which means we don't have to sell the asset typically to get a payday. We can refinance at
Yeah.
50, 55, maybe 60% loan to value. We can pay out our investors. We can keep a couple million dollars for ourselves. When you do that by way of refinance, it's not a capital gain. We didn't sell anything, which means we don't pay capital gain tax. It's non-capital gain, so it's tax-free income in terms of pulling that debt out and recapitalizing. It allows us to keep the asset, allow it to continue to cash flow, take that capital, and continue to scale and move forward towards our goal.
Yeah. Plus, you're getting the magic money depreciation along the way as well. That's
Yep.
the icing on the cake. That where were you all at before your goal of $100 million AUM within 2 years? What was that mark?
In terms of what our goal was,
Well, your goal was 100 million, but what was your starting point?
so my partner Eric Hemingway and his son Levi built their first self-storage facility in 2006 from the ground up, and then did three more conversion projects from 2013 through 2017. They're also in between were bought and renovated hotels and did single-family home construction, neighborhood construction as well. But it all kind of circled back to eventually wanting to get back into self-storage and get back into it in a big way. I met them when they were doing hotels in the beach town where I invest, Carolina Beach. And so I owned a property management company there. There was a lot of synergy there. I was helping them with their hotel projects and doing it for free just because I knew from having beers with them at the local real estate meetups that they were going to get back into self storage. And I said, look, when you do, I'd like to be a part of it. I'd like to try to raise capital. And so that's where we started. So they started with a baseline of cash flowing projects on their own in
Yeah.
terms of hospitality and self storage that basically, like, if you're going to get into syndication, you're looking at several years of it's a valley, right? You're putting a
Yeah.
lot of money into it, and it's a long time before money starts coming out. And when it does, the investors always get paid first, right? We want to make sure they always get paid first, and we're open, honest, and ethical and transparent about everything we're doing. So, because of that, they started with a portfolio of hospitality and self storage. I started with a portfolio of Airbnb properties as well as a property management company. And that was kind of the baseline for me to walk away from cardiology and medical sales and to just go full speed ahead into syndication and self storage. Originally, our goal was try to do $50 million in stabilized assets under management in 2 years, and we were blowing past it. So we recalibrated. We set our goal at 100 million in assets under management. We beat that goal by a couple weeks, and we're looking on the way right now. Interest rates are not really affecting us that much. We always use fixed rate debt, never use variable rate debt. We have a fund, so sometimes we can close a property with cash. If not, banks are still giving us very favorable loans because we're typically buying these buildings for $1 or $2 million less than they appraise for. There's just very little appetite for big box retail, so we can still get good debt. We're full speed ahead, 500 million in 5 years and $1 billion in 10.
Love it.
That's the scale.
What the fund is? It just evergreen, open ended?
It's closed fund right now. We've got a $10 million fund. It's small fund, but we're buying these buildings for very little. So,
Yeah.
a typical purchase price for us. The first Kmart that we bought for 1.5 million. We put 2.5 into it, so we're into it for 4. Appraised value is north of 9, just as the building. Once it's full, obviously it's worth more. The replacement cost on that first Kmart that we bought for 1.5 was 6.5 million with the insurance company. That's what it would cost just to build that cinder block shell. So
Yeah.
it's kind of like, when you flip a house, you don't make your money when you sell the house. You don't make your money when you renovated it. You made your money when it smelled like dogs and cats,
Oh,
and
for
you bought it dirt
100%.
cheap.
Yeah, when you're making money on the buy every time, and if the replacement value of that is say even half off or 75% off, I mean you can't go wrong. You bought it at a basis to where you can afford to screw up many of times before it's even a problem. And not saying you want to screw up, but it just makes it safe. I mean we're
Yeah.
predominantly in multifamily, so the basis is everything. If you're buying at a sub 4 cap, you're screwed out of the gates, unfortunately. bad debt or a market change, it's just a lot of groups are going through it. And
Yeah,
we're
left and right. Just let me put it to you like this. Let's say you and I, right now, as a joint venture, you and I decided to go build a self-storage facility from the ground up. We're spending about $120 a square foot for the construction to build Class A climate-controlled self-storage, plus the cost of the land. With the last 6 conversion projects that we did, the cost of the building, the conversion, the renovation, and the parking lot and everything that comes along with it, we're average $63.50 a square. So
That's
we're
incredible.
about half the cost of the construction, not including the land. And a lot of times we don't need a giant Kmart parking lot
Right.
with the self-storage facility. So sometimes that puts us in opportunity where we can out parcel
Yeah.
and put a Pep Boys or a Cookout Burger there. In the future, we're looking at things like, what does it look like when the federal subsidies roll around to put 97,000 square feet of solar on the rooftop of a Kmart, right? It opens up a lot of opportunity in terms of maybe you fence off this part of the parking lot if you're near a water source and you do boat and RV parking. So it
Yeah.
creates a lot of diversity, but you're exactly right. The original cost basis is what makes all that possible, is that you bought the building for dirt cheap compared to the replacement cost.
Yeah, and that's the value add component. That's why it's so hard to find a deal that actually pencils, where you've got to buy it at this basis, but then you have to still put in. I'm going multifamily, call it $10,000 or $15,000 per unit. So in a lot of cases, these guys have already given their equity away to the sellers that didn't earn the equity. They bought it at a future value, and now you're in the armpit of the deal, going through the renovations, going through the motions of evicting tenants, and then releasing. It's a ton of work, and then finally you get to the end of the value add. You've got it where it's performing, and there's no money to even extract out of all the work you've already given it away. So you guys are doing it right. That's huge value add opportunity, because you're buying an empty building, you're taking an eyesore from the city, you're creating employment, you're creating an operable business, a thing of function where what people need, and you're able to your after renovation value is incredible. What did the operational expenses look like?
It's significantly less than what you would expect with most other asset classes. Like, this is probably an oversimplification, but if you look at multifamily, like, of all the gross potential income, it can be 65 to 70% of that can be expenses in terms of office staff, landscaping, security, maintenance, whatever it may be. And it might be 30% is the net operating income. With self-storage, it's typically the inverse of gross potential income. We're going to have about 30% expenses and 70% net operating income. And of that 30% expenses, as you stabilize, typically that's going to shrink down to 22, 23%, because as it fills, you don't have to advertise nearly as much. We typically have someone on site at most of our facilities until we hit about 60% occupancy. At that point in time, we can move them off to another facility, and we manage with a hub and spoke model where we have one people in a central location that can manage 5, 6, 7 locations. We have QR codes on the door and touchscreen kiosks. We want to gather everybody coming in the door.
Yeah.
Most self-storage are cash flow positive around 60-65% occupancy. Because of the initial low cost basis and the vertical integration of doing the construction ourselves, our break even is typically about 40%. So we're going to hit that 40%. We're going to keep somebody in the property, catching everybody coming in through the door till we hit about 60% occupancy. Then we can pull that person off, move them to another newer location that's booking up, continue to book up through touchscreen kiosks, QR codes, and that fixed overhead cost gets even lower. And then obviously as it fills, the advertising dollars start to go down. You start to increase the rents. And in the long run of all the gross potential income, your net operating income is going to be north of 70%.
Wow, that's incredible. Are you all vertically integrating with like U-Haul and selling boxes and kind of pickles and cheese?
So
Wow.
no, we've tried some of that. The reality is, like, the stores on location selling moving blankets and boxes and packaging, the juice is not worth the squeeze. It just doesn't make sense. And so there are facilities out there that partner with U-Haul. That's not something that we've done yet. Right now, the market is telling us to be in acquisition mode. So we're in acquisition mode, and we're rolling, right? We're scaling. When the market tells us that it's not time for acquisitions, I have a feeling we'll probably circle back and look at expansion projects where we have room to add square footage, or we have projects where we have the ceiling height that we can add a mezzanine for part of the building if we need to. Right now, we're focused on acquisitions because we have a window. But in terms of the long run, yeah, there's always things that can be done to optimize. Right now, that's not where we are. But yeah, we're fully vertically integrated in terms of we do buy some on-market buildings. We also have an acquisition team that's looking at 50 to 70 buildings a week across the Southeast and writing LOIs and full underwriting. So most of the properties that we're finding are off market, some on, some off market. We have a lot of relationships and people out there looking. We raise the capital in-house. So we're not paying retail costs for the building. Typically, we're not paying retail costs for the private or the hard money. We're not paying retail costs for the construction. We're building out in-house. It typically costs plus 12%. We have in-house property management. My partners already own their own self-storage facility, so it made sense for us to just expand that. We're managing typically at around 5% property management, which is less than the national average. So that full vertical integration is one of the reasons why we can leave enough value that it allows us to have a really low LTV at certificate of occupancy and recapitalize by way of refinance, which is paying out our investors mostly. Obviously, there's preferred return and there's cash flow. We're offsetting that with cost segregation study and accelerated depreciation.
Yeah.
But the majority of their income is coming by way of refinance, which is non-taxable because it's not a capital gain.
Yeah, well, I totally am a believer in and actively operating the vertically integrated model of construction management, just the whole piece. And when you can control everything and centrally communications, the procuring of the material, the labor, it's things go the way that they should go. And you know your reduction in expenses is extreme once you can tie all of those together just by sharing overhead, sharing management, and then operating efficiently. We don't just throw money at problems. We get to the root of the problem and fix it versus throwing money and hopefully the spender can fix it and then move on. But totally agree. And then as far as acquisitions go, that's kind of like what McDonald's did. They put all of the franchises out there, and then they built up in-store revenue, such as opening 24 hours, 24/7, then introducing coffee sales. So then you can turn around and introduce new things to your store sales, and then boost the revenue up even more. But definitely acquisitions mode, and then turn around and critique, fine tune, and boost up the production for sure. What
Yep.
are you seeing the market looking like in where you guys are at? Are you seeing opportunity? What's in the foresight here?
Yeah, so we still are seeing opportunities specifically across the Southeast, where we really like the areas that are secondary, tertiary markets across the Southeast. So we're not trying to go into a downtown Charlotte or a Raleigh. A lot of times we're working on these peripheral markets where you've had explosive growth across the Southeast with massive population growth, and a lot of these younger people, unfortunately, are not able to buy houses the way they once did. A lot of them are getting pushed out into these suburban areas, some of these small outlier little towns. So now you're having massive growth there, which are traditionally underserved for storage. And a lot of people in that market, they're renting, they're not buying. So instead of renting a 2-bedroom condo for $1,800 a month, they might rent a 1-bedroom condo for $1,300 a month and then rent a self-storage unit as an extension of the closet or an extension of the garage. So we're specifically looking for feasibility study and population growth, good residential density in a 1,357 mile radius. And because we've seen that population displace, especially since COVID, it's really a lot of people are location independent and moving to where living is a little bit cheaper. They're moving into areas where we don't have to speculate about it being underserved for storage in the future. It's underserved now. But because these towns typically across the Southeast, they have Kmarts, they have agricultural warehouses or old grocery stores. You said it early. A lot of times these buildings have been sitting empty for so long that they're an eyesore. And the town is typically very grateful for somebody to come in and do something with that. And storage is just a sign of growth in the area. And typically we're looking for places that have high vehicle count, high visibility. So in terms of finding properties for us, it's not an issue. In terms of finding capital right now, it's not an issue. The interest rates come into play a little bit, but honestly, like we had really unbelievably low interest rates for so long that people got a little bit high on the horse of where their prices were. We're starting to see that finally kind of take effect and have trickle down there. So we're still able to find the properties that we want. And a lot of times we control that cost because we're not paying retail for the construction or the capital or the management or anything else. So we see opportunity. I think that we've got, the runway to have 6, 8, 10 years of really moving fast and hitting our goal of $1 billion in assets under management. But the key component is my partners. Like I raise capital, I do investor relations, but they're the ones doing the heavy lifting, right? They're doing the construction, and these are big, complex projects. And you have to worry about mitigation in phase 1 and phase 2 and asbestos and all kinds of things. So if you and I wanted to go do this and hire someone to do that level of construction, the potential risk of the fixed overhead costs would make it cost prohibitive. Because we have the vertical integration and I have partners that can do that heavy lifting, we still have plenty of opportunity. But I don't think it's just opportunity for anybody. I think you really have to have that in-house construction right now to make it make sense and be able to control that risk.
Yeah, yeah, no, I totally agree. It's and again, it comes down to control. You're controlling your costs, you're controlling the process, making sure the quality's there, making sure vendors are showing up on time, timelines are being met. There's huge advantages. Just getting rid of the middleman is huge in and of itself. Missing the huge markup, for sure. So $1 billion in 10 years. Are you all? Is it roll it up into a PE play, or what's the just hold forever? What's the ultimate play?
Nomad Capital is named by my partners after, the market crashed in '07, and my partner Eric and his wife Rachel and their 5 kids ended up spending 3.5 years on a catamaran sailboat that they bought in Greece, sailing around the Mediterranean and everywhere else. And that lifestyle was afforded by real estate that they had, self-storage facility, and other real estate that paid for that life for a few years. And that kind of sparked the idea of Nomad Capital. If we're buying assets and fixing them up and selling them off, that's great. And everybody gets a payday, but we're trading time for money. And the day that we stop working is the day that we stop getting paid. Obviously, there's going to be some individual projects that we need to liquidate, and everybody wants to see us go full cycle. But our goal, the reason it was named Nomad Capital, is because a real estate nomad is somebody that can go where they want, when they want, and do what they want. You don't get that way by selling assets. So
Yeah,
our goal is to build a tribe of real estate nomads, build a portfolio through the refinance process, be able to give everybody good short-term returns, but build up a portfolio that in the long run is going to give you not just that financial independence that we talked about, but also time and location independence. Because those 3 things together give you an independence of purpose, where you choose where you want to go, what you want to do, and when you want to do it. In our mind, that's a nomad, and that's the name behind
yeah.
Nomad Capital. So that's the core values. That's what we're trying to do.
Yeah, no, that's totally cool. I like the idea, the thought, and the meaning behind it for sure. It's I think that's what we're all after. It's just uh, the herd is everywhere, and I mean the herd. Like when everyone goes to that one thing, it is extremely tough to break through, and you all are doing it for sure. What are you seeing with competition out there as far as you all go through saturation and absorption ratios, just like we do on multifamily? What's it looking like on the permits? How many's coming online? So what is that looking like in your all's world?
Yeah, so feasibility study, we're always looking at what's currently in the market. We also look at permits as to what's coming down the pipeline.
Yeah,
The beauty of self-storage is, what really matters? About a 7-mile radius. That's
yeah,
about as far as people are willing to drive for a self-storage facility. The traditional self-storage model is very fragmented. It's mom and pop. It's mostly non-climate controlled. If you come into a market where the younger generation is using it as an extension of the closet and extension of the garage, which means they're putting their kayaks, their mountain bikes, their snowboards, and their winter clothes in there. They're using it as an extension of that garage, which means it needs to be safe, secure, well lit, easy access, and climate controlled. Get in there at 6 a.m. on a Saturday morning, grab their snowboard and their bibs, and get out of town. If you're listening to the consumer and that's what you're building, it differentiates you a little bit from the other storage that's in the market. On top of that, if you come into a market and you drop 80,000 square feet, which is going to be 60 to 65,000 net rentable, it's really kind of hard for anybody else to come in and compete with you in that space in a secondary, tertiary market, especially when everybody in town knows where that building is. So I think that gives you a strategic advantage. On top of that, it's about 7 miles is about
yeah,
as far as people are willing to drive for storage. So we have competition. And we're not the only ones doing this. There's groups out west and in the Gulf states and the Northeast. There's different people, different places. I really do believe that the only people that are pulling it off in a meaningful way have that full vertical integration,
yeah.
which takes time to build up. So I don't think this is a forever thing, but I do think that we have the 6, 8, 10 years that we need to hit $1 billion in assets under management for ourselves and our investors.
Yeah, well, you all have a competitive advantage by being vertically integrated. That's a premium operator. When you have those components, you're not just a syndication firm relying on third party. You are the firm. You are in control, and you can give the investors good, bad, and indifferent news. It's all coming from you. It's I love it. Um, if you could give advice to somebody, put yourself 20 years back. If you could give advice to somebody from 20 years ago, what would it be for them to get started in the industry? And if you could skip ahead.
Number one, I would say to probably think bigger, but understand that when you think bigger, like look at the strategy that you're looking at and if everything goes perfectly, what's the ceiling, right? And if that's not enough to change your life in a meaningful way and the amount of time that you get to spend with your kids and grandkids, then it's probably just a stepping stone, right? And if it's a stepping stone, then focus on the lesson, because ultimately the lesson is probably going to translate to whatever you do next. The same thing I was doing with small Airbnb multifamily properties is the same thing that we're doing when we convert a Kmart to 600 or 700 units. On top of that, know that the whole is greater than the sum of its parts. In terms of syndication, you have to have three things to have success with real estate investing. It's time, it's experience, and it's money. You don't have to have all three of those things, but you need all three of those things, right? So if you have time, use your time to get experience. If you don't and you have capital, use your capital and partner with somebody else that has the time and the experience to get it done. But overall, whatever you do, even if it goes from thousands of dollars to millions of dollars, it's probably the same underlying concepts, and understanding the concepts. And then on top of that, it's relationships and ethics and communication that, the same thing that you're going to learn when you flip a house or a single family or a duplex is likely to be a lot of the same lessons if it's a 120 unit apartment complex or an RV park or a self-storage facility.
Yeah. To just top that too is one thing that was told to me is never bite off something bigger than your head. Meaning, if you don't know the next 5 moves, get around people that do and learn from them, absorb it, and then that will raise you up as well. The boats all lift together. Very cool. If somebody wants to reach out, get a hold of you, learn more about Nomad Capital and yourself, how can they get a hold of you?
Best way to reach us is just our website is nomadcapital.us. You can schedule a call there, or you can reach out to me directly, Clint, CLINT, at nomadcapital.us. I talk to investors all day, every day. I love it. I'm an extrovert. I always learn something, and I'm happy to connect with anybody that wants to chat.
Awesome. Definitely appreciate your time. Look forward to following you all, and we will certainly talk soon. Thank you.
Sounds great. Thanks, Josh.
Thanks. Bye.